this is Nancy Lennard, Senior Partner at Lennard & Associates. Today I'm going to talk about what you need to know before you acquire an existing business. Typically, the first step when you are acquiring a business is started with a letter of intent or memorialized with a letter of intent or memorandum of understanding. Abbreviations for those are LOI or MOU. These are interchangeable terms, whether you're talking about an LOI or an MOU, they're pretty much the same document. The LOI or MOU is typically the outline, skeleton, or framework for the actual purchase agreement. It's not necessary to have it, but often it's negotiated so that all of those terms that are going to be the business terms of the purchase agreement are already negotiated and memorialized. Some of the key terms, it's stated as a non-binding document, but be careful because although it doesn't create a contract by itself, hence it's non-binding, the terms that are in it are typically not renegotiated at the time of the purchase agreement. Some of the key terms are the purchase price, whether it's an asset or a stock acquisition, the terms and conditions, if there's a non-compete, the terms and of the non-compete, whether it's an as-is transaction or if there are representations and warranties that the seller is providing, any conditions or contingencies, and what would be the due diligence period. So let's talk about asset versus stock acquisition. In a typical transaction, I almost never would recommend a stock or membership interest acquisition, but almost always an asset acquisition. And the reason for that is that you are buying the liabilities of the business when you're buying the stock or membership interest of the business. So it's a very rare transaction in which I would recommend the purchase of the stock or membership interest. Acquiring the ownership of the entity bears huge risks. Some of the unknown liabilities, for example, you don't know if there might have been a catastrophic event that happened a year earlier in which the parties have not yet filed suit. There's no way to know about that and no way to protect you from that. So you can never be sure of the liabilities that are outstanding that you may inherit when you're buying the actual entity that owned the business. Buying assets of the business allows the buyer to choose the assets that he or she wants to acquire and avoids the liabilities of that business. Acquiring the entity means that all employee benefits continue and the new owner is liable for those benefits that have accrued prior to the closing date, which if you're just buying the assets, typically you are not getting the liabilities for the employee benefits that accrued prior to closing. So generally it's best to buy the assets of the business and not the ownership of the entity that owns the business. What kind of due diligence should be performed before you acquire this business? Well, you should have your accountant review 3 years of the business's tax returns, so the 3 prior years. You should have us review, or you should review all the permits and licenses for the business. Make sure that they are current, that they are all there, and the kinds of permits and licenses that you're going to need to enter into and have. We should review all of the contracts and leases of the business so that you know the terms of all of those contracts and the term of the lease and what's remaining on them and whether they really have value to the business. Review or have your accountant review the financial statements of the business for the past 5 years, along with a letter from the business's CPA or from that's a reputable CPA that indicates that this business is compliant with all accounting requirements. Review customer lists, sales records, advertising materials and costs, employee and management contracts and benefits, and a review of all the intellectual property owned by the business, such as trademarks, copyrights, patents, domains, and any other intellectual property that's out there. So what is the information that we need for us to draft the purchase agreement? And we would prefer to draft that purchase agreement for you as it puts us in the best position in representing you from the start. We will need a full list of the assets being sold. For any hard assets like equipment, machinery, computers, we prefer to also have the manufacturer, model, and serial number for those assets. We provide a questionnaire after we've been retained that asks for all of the information that we need in order to draft the purchase agreement. So a full list of the assets being transferred with, as I said, manufacturer, model, and serial number where applicable. Full list of assets not being transferred, those that are being excluded from the sale, is important to have. A full list of the assets with liens or encumbrances, so you know what assets you're buying that aren't free and clear, that have money owed. A list of all equipment and real estate leases that need to be assigned. The purchase price, the allocation of the purchase price, which can have a huge tax implication for you. And so we ask you to get your accountant involved to advise you on that. How is the purchase price going to be paid? Is it a cash transaction at closing? Is there a note that you're going to be providing to the seller who's taking back part of the purchase price under a note? What is the proposed closing date? What kind of conditions or contingencies are there? For example, is it conditional on the franchisor's approval or the landlord's approval and assignment? If this is an as-is deal, or will there be representations and warranties provided by the seller? Closing documents. Here's some examples of the closing documents that we will need to have and prepare for you. We'll need a signed asset or stock purchase agreement, a transfer of all the intellectual property rights, including any domain and website ownership, assignment of the real estate lease and any equipment leases, along with the landlord's consent to those, assignment of any franchise agreement or entering into a new franchise agreement if that's required, non-compete agreement if that's a part of the transaction, the bill of sale, which is the document that actually provides title to the assets, a bulk sales affidavit and or tax clearance letter from the state that the business is located in, all of which are important documents to have at closing. If the purchase price is borrowed, typically from the seller, then you're also going to need a promissory note that documents that loan that you're taking out with the seller. And it's very important to have an experienced attorney review that or draft that. The note will probably contain the following: the dollar amount borrowed, the term of the loan, the interest being charged on the loan, the monthly payments, what are the default and remedy provisions, what kind of notice are you given if you are in default. There will also likely be a security agreement. This accompanies the note, and it describes any collateral or security that's being given for the promissory note. And typically in a business acquisition, the collateral are the business assets being sold so that the seller can take back the business if you are in default. And if there is a security agreement, typically there's also what's called a UCC financing statement. UCC stands for Uniform Commercial Code. Financing statement, it's called a UCC-1, and it's filed with the state, and it lists all of the assets that are collateral for the loan. So our services are that we advise on the due diligence that's needed. We help with that due diligence in reviewing contracts and leases. We will prepare all the documentation that's needed for the purchase or sale of the business, including promissory notes, the bill of sale. We'll get a tax clearance from the state and so on. We advise on the warranties and other provisions of the purchase agreement, the representations and warranties from the seller that are important to have. We assist with proper structure of the business and how you want to set up your new business and form the new entity for that business if you want us to. We'll review all the leases and contracts and provide advice about them. And if this is a franchise business, we can assist with also evaluating that franchise opportunity. So again, this is Nancy Leonard, Senior Partner at Leonard & Associates. My phone number is 215-392-0030, extension 101. And my email is nleonard@leonardandassociates.com. I'm excited to talk to you about this opportunity and look forward to working with you. I hope you found this presentation helpful. And feel free to give me a call or drop an email off to me if I can help in any way. Thank you so much for listening to this presentation, and have a fabulous day.